And so for all the government's complaints about the OBR, and indeed the complaints of previous governments about the OBR, actually if you swapped in the average city forecaster's views, they'd have no headroom whatsoever. They'd be in real trouble.
Hello and welcome to Spectator TV. I'm Michael Simmons, the Spectator's economics editor. And this week we've had lots of economics news, both here in Britain, but also from across the pond. So joining me to discuss all of that is Archie Hall, the US economics editor of the Economist magazine. Archie, thanks very much for joining Spectator TV. Today we've had GDP figures that showed that in the second quarter of the year, the economy grew by 0.3%, and there was particularly strong growth in June. Is this all good news?
Stronger GDP is pretty much always good news. That's that. So we'll certainly take that. And Britain's had a fair run of pretty weak GDP, so it's a nice surprise. How good the news is, I think, is tough to say. The GDP figures in Britain have kind of been quite choppy over the past year. A lot of big movements up and down, some revisions and so on. And so whether we're certain about quite how good this news is and whether this is news that's going to kind of persist into the next half of the year, I think is the more difficult question.
And the news, sort of the figure 0.3%, is down considerably on the 0.7% growth that we had at the start of the year that did, mean Labour were meeting their aim of being the fastest growing G7 nation. How much of the sort of slump in growth can we blame on the president of the country that you now live in? How much of this is, consumption brought forward because of tariffs?
Yeah, it's difficult to say. It definitely seemed like, and it's always kind of difficult to precisely draw the inferences, but they're just in the same way that kind of US growth is very distorted to the downside in the beginning of the year, then to the upside a bit later. More recently, you had kind of the mirror effect in various other countries around the world, including the UK. And that's one of the reasons why it's quite helpful to kind of look at this now over a full 6 months of data that we have, where you have had kind of both the pre-tariff and post-tariff period. There's good reason to believe that in general, Britain is probably a less tariff-exposed country than much of the rest of the world. We export mostly services rather than goods. That's very unusual for Britain compared to other countries. I mean, in addition to that, the kind of tariff rates have obviously moved around a ton, but in general, Britain's been on the lower end compared to other countries as well. So there are reasons to think that actually the tariff impact is not going to be too bad forward-looking, and probably has been less bad backward-looking on Britain than other countries, but definitely present and very plausibly distorting the figures, particularly early in the year.
And what do you think this means for the Chancellor and for all of us come the autumn budget? Last week we had a forecast from one of the economic think tanks saying that her fiscal black hole was £50 billion, and a lot of that is based on GDP coming in lower than forecasts had predicted, and the OBR having to move things around on their abacus to adjust for that. But these figures were better than expected. So does that mean that Rachel Reeves is in a less sticky position? Is the hole a lot smaller?
It's a difficult question. I mean, so the numbers from NISO that you mentioned, the think tank, are certainly on the higher end of people's kind of estimates for how stuffed Labour is. But it's also definitely true that the Chancellor's left a very thin margin of headroom compared to her predecessors, and that most of the developments since the past March have been kind of negative ones that would likely kind of erode that and almost certainly push her into the negative territory. And that's everything from like tariffs, their impact on growth, your movements in gilt yields, and much else. And the particular thing you mentioned from the OBR, I think, is actually really important and worth dwelling on, which is that the OBR is a very, very optimistic forecaster of British growth relative to pretty much everyone else. I mean, I ran the numbers on this a few months ago, and they were in something like the 85th or 90th percentile around then. Obviously, it varies from time to time, but so really very optimistic compared to your forecasters in the City of London, the Bank of England, and so on. Bank of England's moved their forecasts up a bit more recently. And so for all the government's complaints about the OBR, and indeed the complaints of previous governments about the OBR, actually, if you swapped in the average city forecaster's views, they'd have no headroom whatsoever, and they'd be in real trouble. And that's been true for this government and previous governments. And the OBR is meant to be looking at this over the summer. What conclusion they reach, I think, is tough to say. It's a bit strange in the sense of if you're the OBR, you're thinking about this as a kind of 5, 10 plus year problem. What's the long run potential growth rate of British productivity is the kind of real exam question you're trying to answer. And so what happened to GDP growth in June of 2025, in some sense, feels very relevant to that. That's 1 month of information, and you're working on kind of trying to interpret decades-long trends. But obviously, certainly, if you're trying to kind of squint for an uptick, and if you're trying to make the argument stick that Britain's been through a really tough time with COVID, with the lingering impacts of leaving the European Union, the impacts of the Russia-Ukraine war, and that actually the pretty paltry productivity we've seen in the past kind of few years isn't representative, then certainly this kind of thing is helpful for making that argument and could maybe nudge down the size of the kind of downward revision if the OBR does do one. But again, it's a month of data and it's a decade-long question.
And why do you think the OBR historically has had this kind of positive bias? Like, is it political pressure? Because it doesn't seem to, make sense that this would be something the government wants, that between fiscal events, it always has a hole to fill, partly because wild optimism from the OBR is never matched by reality. What do you think is, causing this positive bias in their forecast?
I mean, if you're the government, this is a good problem to have. It does mean, yes, you have a hole to fill, but it means looking backward, you had more space to borrow and without claiming you're constrained. So mostly, if I were a cynical government, I'd be happy with the situation, not sad with it. My read, and people obviously different reads, I wouldn't interpret it as political pressure. Pretty much every British economic forecaster has been slowly revising their productivity growth estimates down over the past 15 years. The assumption was, in the immediate aftermath of the financial crisis, that Britain would pretty soon return to quite strong performance that happened before then. Obviously, that didn't happen, and so the OBR's assumption was initially that there would be a kind of effective return to pre-crisis performance. Then they moved sort of towards the back end of 2010s to an assumption we get about halfway back, but not the full way back. And then now we're getting to a situation where kind of even that, particularly given the weak post-COVID performance, might be difficult to sustain. My read is it's effectively just the costs of lowering it are very, very high for the OBR. So everyone will be happy with you if you say, congratulations, we've realized the British economy is actually going to be more productive. Chancellor, here's much more room to borrow. If you're going to be the bearer of bad news and you're going to kind of, ruin Philip Hammond's budget as they did in 2017, that's a much tougher position to be in. I think you have to feel as the OBR that the evidence is really, really, really strong, and you're always going to be biased doing a smaller move or waiting longer. So I think that's what we're seeing right now.
Moving on to the other news we've had in UK economics this week, we had figures about the labour market that show that continuing to cool. There was over 160,000 job losses year on year in July when you look at sort of payrolled data. Is labour costing people their jobs?
Gosh, well, I mean, the first question with British labour market statistics, as you'll know, is that we basically don't know what's happening because the kind of quality of the labour force survey, it's usually where you'd pull a lot of these numbers from the Office of National Statistics, is really quite weak now. There's been a huge decline in response rates, sort of big issues there. And so drawing any conclusions, I mean, that's a frustrating answer, but drawing any conclusions is difficult. That said, yeah, I mean, my read of the kind of full ambit of the data, both the official statistics and also kind of the anecdotal stuff and also surveys and so on, definitely suggests the labour market's cooling. I personally wouldn't blame Labour a tremendous amount for this. My view, at least, is that Labour absolutely did bring in a substantial tax rise with the national insurance employers' rise. That in the long run is going to be pretty equivalent to the undoing the tax cuts in employee side national insurance that Jeremy Hunt put in towards the end of the election. So moves the British tax system back to around where it was in 2013. There are going to be pretty substantial transition costs associated with that. And that's because employers can't easily kind of cut people's pay instantly to say, actually, we're paying more tax, you're going to have to pay less and just pass it all on. That'll happen over time. And so there's definitely been a hit to businesses, some of which is going to be processed in kind of people having fewer jobs in the past 6 or 12 months. That to me, the specific tax bit of that feels pretty kind of passing and transitory, if I had to guess. The broader labour market dynamic that I think sort of is worth paying attention to is more just the kind of ongoing impact of high interest rates. The Bank of England kind of very, very slowly kind of pushing the labour market back into balance. And that's deliberate. That's in order to kind of get inflation slowly back. And if you really did want to blame Labour, I actually, and no one really makes this argument, but the thing that I find more persuasive is that, number one, the budget in October was a very expansionary budget. They increased borrowing net by something of the order of 30 billion a year. And the OBR's forecast, and those of many independent forecasters, suggest that is going to and has been increasing inflation. So if you're thinking the thing that needs to happen is inflation needs to get down, the Bank of England can cut rates, that's being made more difficult, at least in the short term. It's the first thing. And in addition, just a number of the kind of other labour market changes. So the national insurance rise, but also the minimum wage rise. Also outside the labour market, kind of the way water bills have gone up a huge amount. There's lots of government policy in the inflation rise right now that's also making it harder for the bank to cut. So that's where I see the role of government as being stronger. I think there's definitely a transition and some costs associated with Nix, and people disagree on this. I don't see it as the kind of hammer blow that I think some of the business community say it is.
And you mentioned interest rates there. Obviously, the bank just cut them to 4%. I wrote the Spectator cover story a few weeks ago saying that a lot of the economic woes that this country is in recent years is because of decisions of the Bank of England and letting inflation run really hot. In Andrew Bailey's tenure, he's averaged more than double the 2% target, and the bank now forecasts inflation to hit 4%. I know you've looked at sort of inflation expectation kind of surveys, and it's something you worry about as well. Tell us a bit about that, but also in the context of the GDP figures that we started this episode talking about, with more demand in the economy than had been expected. Do you think that makes the bank's decision last week a bit harder to justify?
No, it's tough. I mean, I was at times reasonably critical of the Bank of England as well. I think less so than your piece. I mean, I think it's worth, as much as it's true that inflation's been much higher in Andrew Bailey's tenure than kind of previous governors, it's also true that that's been true across the world. It's also true that that's, to the extent that it's been specific to the UK, and a lot of this is, the impact of the Russia-Ukraine war or the impact on gas prices and so on. It's a global phenomenon, or indeed kind of COVID supply chains. I, at least personally, mostly would attribute the domestic portion of UK inflation in the past 5 years to the kind of impact of the fiscal stimulus around COVID. And so you had a vast amount of government spending flowing into the economy through the furlough,
which was enabled by the bank's money printing.
Sure. But the fundamental decision maker there was the central government, and you can dispute if the bank hadn't been doing quantitative easing, what the interest rate impact would have been, and so on. But I wouldn't place that kind of really squarely at the bank's door. I basically say that was a decision made by, at the time, Richard Sunak and Boris Johnson. It was a decision also supported across the political spectrum. So it's not one that I think you would kind of say that, Labour was on the right side of either. It may even have been the right decision. The flip side of high inflation was also, we didn't have a deep recession post-COVID. We had a pretty quick one that sort of came back, and the recovery's obviously been weak, but it wasn't apocalyptic the way people thought. My own personal view is, if you go back there, that the evidence is pretty strong, both in the UK and in the US, that response was overdone and probably did contribute to inflation. And probably, for instance, the furlough scheme could have been wrapped up earlier. The scale, if you want to go a bit further along, of kind of Liz Truss's energy price support was probably quite poorly targeted and quite big relative to what was necessary. There's some good work by the IFS on that. And so, absolutely, in my mind, the Bank of England made a forecasting error, as most central banks did, which is to say they saw inflation coming in 2021 and were willing to dismiss it as transitory and not raise rates. My sense is that even if they had raised rates faster and sooner, that probably there still would have been a fair amount of inflation. There would have been less, but that we wouldn't be in a totally different place. I think the one sort of place that may have helped a bit more is on the inflation expectations, where you mentioned, where just the notion that kind of the central bank is actually credible and has a handle on what's going on, isn't repeatedly being surprised, is probably quite good for making people believe inflation's not going to run out of control. And the world we're in now, where British inflation expectations are creeping up, and not unreasonably, people have had inflation above target for coming on 5 years, or a bit like 4 years now, is quite worrying. And so definitely there was an error by the bank on the kind of broader what share of responsibility to apportion. My sense is a lot of it's global, and the share that's domestic, I'd put more with the government than with the bank. But opinions differ, of course.
And another area that you've written quite a lot about for The Economist is the notion that Britain is now, quite a cheap place. Certainly, if you compare to America, where you are now, British services are really affordable. If you're an American company, it makes sense to Britshore or offshore to Britain. Our equities, have been undervalued for a decade, and we're seeing more and more now American sort of investment moving into areas of the UK because of that. Do you think now is an opportunity to buy the British dip?
Very possibly. I helped us kind of put something saying that on the cover of The Economist. So for the sake of the cover of The Economist not being a contrarian indicator, I hope that's the case. No, I mean, so there's two pieces of that. There's the kind of labour market piece, first of all, where I think the evidence is a lot stronger, which is that British labour has gotten very cheap. And so the measure that I used in the piece, it's kind of a very crude one, but I think is pretty helpful, is if you look at kind of the average British wage denominated in US dollars, so effectively how much it would cost you as an American to buy the average British worker, buy their labor. If you go back to 2014, 2015, they were pretty close. Britain was a smidge lower, maybe 10%-ish, but not vastly so. Britain was actually even higher pre-crisis, given how strong the pound was then. And if you zoom forward to today, Britain's now kind of something in the reach of 30% lower, if not a bit further. And so you have this kind of big divergence, and that's even bigger in a number of specific industries, that has opened up a real opportunity. And if you go through the kind of British GDP figures and basically just try to find any success stories in the past 10 years, it's pretty hard, because as we were saying, the long-term growth story is pretty bleak. One of the really striking ones is services exports, which have absolutely boomed in the past 10 years. And to my mind, a lot of it kind of lies on that cost differential. And for the piece, I went and spoke to a whole bunch of companies. I think the most memorable to me was speaking to JP Morgan. I put this in the piece, but they do a lot of their kind of IT coding kind of tech stuff out of Glasgow, and said at this point the Glasgow labour market for them is about in between Texas and India, but if anything closer to India than to Texas, which is a really, really, I think, striking thing, and kind of burst a lot of illusions in Britain about kind of where we sit these days in the global economy. Indeed, actually, last night I was having dinner with some people for the US-based magazine, which hires a number of UK-based editors for exactly that reason. For many other reasons, I'm sure, but in large part, it certainly helps that you can kind of access smart humanities graduates pretty cheaply and get them to edit your magazine for you. So that in one sense reflects quite a dispiriting story, which is the slowness and the kind of fall behind of the British economy in the past 10, 15 years. Given where we are now, though, I think it's actually quite an encouraging story to tell, which is that people are noticing the fundamentals of this economy in many ways are strong, and kind of correction is happening, and we are seeing a lot of opportunities being created by that weakness that hopefully will bolster the economy going forward. So the dip is definitely being bought in labour. On stocks, and bonds, it's tougher to say. I mean, they're definitely a lot of measures of valuations of British assets suggest they look very cheap. Now, as any investor will tell you, if something's cheap, you should first say, why is it cheap? And is it cheap for a very good reason? And there are certainly plenty of potentially appealing reasons for why British assets are cheap. If you look at British bonds, then the hangover of the Liz Truss experience, I think, is definitely part of that, alongside the kind of repeated brushes with bond vigilantes we've seen under Labour. If you look to stocks, then the fact that the UK equities are very, very skewed towards your sort of unsexy old sectors, slow growing, your natural resource extractors, your banks. There's very, very little tech in the main London equity indices, and that's really what's held up the American market. So there are good reasons for that cheapness, but also that cheapness is an opportunity, and definitely along with Europe, kind of post the Liberation Day kind of drama and post some of the declines that the American equities market saw, which obviously have reversed a little bit more recently. There has been a good amount of kind of flow into UK and European markets. Whether that persists, who knows? Whether that's a momentary dip or whether that is the dip to be bought, be tough to say. But certainly they're doing well and not vastly underperforming American markets, which has not been the pattern for a long time. So that's good news.
You've just moved to Washington, doing this new job as the US economics editor of the Economist. I'm conscious that we've brought you on our show today, and I've just asked you about Britain. So we'll cross the pond now. Trump unleashed his tariffs at the start of the year, and all the predictions were this is going to be Armageddon for the American consumer and the American and global economy more widely. But so far, we've seen inflation kind of holding steady, growth has held up, and the revenues that Trump said would flow into the US Treasury, so far at least, are flowing in to the tune of hundreds of billions of dollars. Is there anything at all that can stop the US economy?
I think tariffs can certainly slow it. And so it's absolutely, as you say, I think a lot of the, if you looked at the recession odds in the betting markets, let's say, around when the tariff announcements, the really big ones at the beginning of April happened, they absolutely skyrocketed. I think from recollection, they went to something like 70% odds of a recession happening this year. And they've now gone all the way back down. And last time I checked, we're more in the region of kind of 30, 40, which is still pretty high relative to usually your average year, they'd be about 15. But is a lot lower. So definitely there was a moment of big panic, and exactly the same thing you could see in stock market, the bond market, etc. That seems to have subsided. The the thing that makes me, I think, less comfortable with the claim that there's going to be no impact for these tariffs on the American economy is exactly the thing you were saying of all the revenue that's now flowing in. So the thing that we saw in the first few months of these tariffs coming in was partly the rates were moving around a lot and often were a fair bit lower, given there were kind of deadlines in phasing them in and so on. But also companies had stocked up lots and lots and lots of goods in the US, kind of on the right side of the borders before this happened, exactly so that they could at least kind of get a few months of not having to pay the tariffs and getting those profits before they kind of really bit. And that's exactly what was distorting the GDP figures in the way that we were discussing beforehand. So that kind of meant that actually the amount of tariff paid up until around kind of June or July was rising absolutely, but not high and not that high, and it's now getting higher. It's probably going to get even higher from here. But what that also means is that effectively companies and Americans were insulated from the effects of that for the first kind of month or two of the tariff hit. And so I think we're only really in the past few months seeing the full brunt of these things flow through. And I think the statistic that kind of comes to mind for me is that when we had the first set of Liberation Day announcements, the effective American tariff rate that those were going to rise the tariff rate to was in the region of about 22, 23%. It depends exactly how you calculate it, but around then, up from sort of single digits. After 90 plus days of negotiations and deals and to and fro and so on, we're at something like 18%. And so we're most of the way there to the same numbers that were causing that kind of huge panic in April. And so that makes me cautious about saying there's going to be no impact. You can maybe see a little bit already. So the inflation figures you mentioned are still not anywhere near the kind of crazy heights they were in 22, 23. On the other hand, they've stopped falling. So American inflation it seemed gradually heading back towards its 2% target. It's now kind of reversed. It's heading up. At headline terms, kind of much closer to 3. And if you go under the hood there, you can see goods prices going up and the sort of the things you'd expect to go up if people were passing at least some of the impact of tariffs onto Americans to go up. And in growth terms, if you kind of average over the entire first half of the year, so you just try to look through the kind of crazy distortions in the first half when people pulling goods into America and the kind of crazy distortion in the second half when that was being undone, you see that American growth in annualized terms was about 1.2% in the first half of the year. Now compare that to 2, 3, which was basically the run rate for kind of most of the years before that, certainly since 2022. And that does feel like a real slowdown. Now, does that stick? Is that a blip? How long does that persist? I think is an open question. But it certainly feels like with an 18% tariff rate, that's a pretty big shock, and you'd expect that to have some impact.
And finally, I've decided every time I speak to an economist or an economics commentator, I'm going to ask them one big, mean question.
Oh, very good.
So you're one big, mean question, and these are designed to answer, how we've got to the kind of mess we're in now, really. And the kind of problem that underlies every issue we now talk about in, British economics and the British way of life is that famous graph of, growth going upwards, 2008 happening, and then us just never returning back to that trend. Why have we never recovered?
If only we knew. I've always thought that graph's a little bit unfair. I think the better version of the graph is to compare Britain's trends to the trend of other economies like Britain. So to America, Australia, Canada, Europe, etc. Because pretty much every economy in the world saw a slowdown in its growth rates in the 2010s and did not return to your kind of pre 2008 kind of rates. Now, what's also true is that was particularly pronounced in Britain and was worse. And so even if you do the version of the graph I think is fairer, where you compare Britain to the trend of other countries, you do still see an impact, like not as big one. And I think that's a much fairer comparison because you can argue that the run-up in 2010 was quite bubbly, was not a thing that's going to be sustained. If there are global factors, you can't blame British governments for them, etc. And that global situation, there's a whole kind of secular stagnation debate about what's going on there that we can bypass, but there's certainly a lot. On the Britain-specific piece of that, it's difficult. I mean, my own view on Brexit is that kind of at least a percentage or two of GDP, Britain's kind of GDP deviation from the rest of the world can probably be attributed to that. That's obviously something that different commentators will have different views on. Definitely does not tell the whole story, and definitely the people who claim that it's a very, very big number, to my mind, are over-egging what's going on. In terms of kind of what else has been driving that, you do have a lot of kind of long-running issues with the supply side of the British economy that's sort of bit harder in the in the 2010s. So I'm thinking specifically there about the housing market, specifically there about the energy market as well. I mean, in both cases, the sort of fundamental inputs to an economy and to economic growth in some sense are kind of like people and energy are pretty foundational. And then kind of housing is a way of making sure you kind of have the people where they need to be in the places that the economic kind of opportunities actually exist. And energy is kind of fuels, obviously, if you're manufacturing, anything you're doing, but also kind of underpins people's daily lives and the services economy. And there have been real issues in both of those. And those issues kind of go back quite a long way. I mean, the housing market, they arguably go back almost a century. And in energy, they kind of certainly date into some of the decisions that were made in the early 2010s around kind of the pace of Britain's decarbonization. Before that are the degree of our dependence on gas. But I think it's true and fair to say that a lot of the places where kind of economic growth was strongest in Britain were pretty constrained by issues in the housing market. So, London, for instance, I think it's fair to say that Britain was particularly hard hit by a spike in energy prices post Russia Ukraine, which reflects natural gas dependence, but also reflects things like not having coal on the grid and so on. Reflects things like not having a ton of nuclear because of regulatory issues that definitely amplified the hit there. And also the places where you kind of expect there to be more growth in Britain based on comparisons to other countries. So kind of Manchester, Birmingham, Glasgow, Britain's second cities are a lot less productive than the equivalent second cities of France or Germany or other countries that we think look like Britain. To my mind, a lot of that is basically infrastructure story and kind of not having good enough road connections, rail connections, etc. And so none of those are things that changed in the post-2010 era. I think some of the energy bits are in terms of decarbonization and so on, but a lot of the decisions about how we regulate energy construction and so on have gone back a long way. But they were things that kind of started to bite a lot harder as with population growth. I mean, in the housing market, definitely migration's also, I think, not the whole story, part of the story in terms of what was kind of pushing prices up as well. And so all of that made it kind of a lot harder for that growth to happen, in addition to all the kind of specific issues in the 2010s. Anyway, long-winded answer. I don't think there's one easy solution. Different people, different views, but I think that'd be my best bit.
Archie, thanks very much for joining Spectator TV.
Thanks very much.